Okay, thanks for joining. This is video number 5, and today we're going to talk about closing costs. What are closing costs, what they consist of, and what you need to know as you're going through the process to either purchase or refinance your current home. Hi, my name is Mike Spindler, and thanks for joining. I'm a mortgage broker with Edge Home Finance. I've been in the mortgage industry for over 25 years, and I've helped thousands of clients purchase and refinance their homes. In this channel, we talk about all things mortgage. So if you have any questions that you want to connect with me on to discuss, you can call me directly at 612-590-8623. Or you can find my contact information below if you prefer to email or text, etc. Happy to help you out, whether you use me or not, for purchasing your next home. Today, we're going to talk about closing costs and what are closing costs? What do they consist of? A good rule of thumb with closing costs. So when you're putting money down, you're purchasing a new home, let's say, and you have your down payment, which is a down payment towards the loan. So the purchase price minus your down payment equals your loan amount. Well, the other part of that is what we call total cash to close, which also includes your closing costs. So you have down payment plus closing costs is your total cash to close. What we're looking at in closing costs, we're going to cover the different sections of what everyone calls in the lending industry your loan estimate, your initial loan estimate. And really, in that loan estimate, it's broken down into two separate sections. Section 1 being actual loan costs, and Section 2 is other costs. So other costs are basically prepaids, and we'll cover that section here when we get there. But let's start with the loan costs. So when you have your loan estimate is broken up into different sections, Section A through Section G or H, I believe. But when we're talking about loan costs, there's a few different sections that we'll talk about in actual costs. So these are actual fees that you're paying for the mortgage. In Section A is lender costs or origination costs. So this is the only section within the full loan estimate. So all the costs, all the closing costs and prepaids. Section A is the only cost that your lender controls. So it's the lender fees. Me as a mortgage broker, I have zero lender fees. I have zero costs in my loan estimates. But typically, when you're going through and you're purchasing or you're refinancing your home, the lender fees will equate to between $1,500 and all the way up to $3,000, depending on how much that lender's actual fees are. In the lender fees section, you're going to see underwriting fees. You'll see origination charges. That's where you'll see if you decide to buy any points, and I'll do a video on what points are. But basically, when you buy points, 1 point equals 1% of your loan amount, and you're essentially buying the interest rate down. So paying to get a lower interest rate. So it'll have the discount points that shows when you're buying the interest rate down. And then there could be administration fees. A lot of different lenders. There's some junk fees that they put in there, but that's where the lender profits when they're going through the mortgage process for you. So Section A is the only section within the entire loan estimate that the lender controls. Everything else, which we'll talk about here now, is from third parties, other parties, or prepaid items that you pay. Now, Section B. These are labeled as services you did not shop for or services you cannot shop for. Some of the things that are included in Section B costs will be for the home appraisal, so determining the fair market value for the appraisal, credit report, a flood zone determination to make sure the home's not located in a flood zone, so you have to pay extra insurance to protect the property. There's tax service fees. There could be third-party processing fees. That's typically what you'll see on Section B. And these are things you cannot shop around for. These are things that the investor, Fannie Mae, Freddie Mac, HUD for FHA, VA, they all require these items get completed on the loan to ensure their investment, basically the money that they're investing to help you with the purchase of your home. So these are things that need to take place that you don't shop for. The next section, Section C, these are costs that you can shop for. And this section primarily is your title company costs or your closing attorney costs, depending on what state you're in. Title companies, I work in a title company state. All states are a little bit different, but Title companies basically they'll have closing fees to sit down with their closer to sign the final loan document package. They'll do a title examination or a title search to make sure that the title on the home that you're purchasing is clear of any liens. There's lender title insurance, which is part of that title search process and making sure the title on the home is clear. And then there can be other like wire fees, document preparation fees, just different things that the title company has to do to get your loan ready to close, and working with the lender throughout the process, sending the title docs, sending their guarantees of what they found in the title search, etc., with title insurance. So that's the title company fees. I'm in Minnesota, but all states, I think title companies, you can shop around. Typically, your real estate agent will have some title companies that they work with that do a really good job. So definitely take their referrals on it. You can go with whoever you want to when it comes to a title company or a closing attorney. That's up to you to choose who you want to. It's really good most of the time to just work with the team that your real estate agent or your mortgage lender refers, because you can shop around a lot for different title companies, but in actuality, and this is just based on my 25 years of experience, you'll maybe find and save $100, $150 between title companies. So there's not a huge difference between the costs of each title company and the services that they offer, and they all do the same thing. The main point is you want to work with a good title company who has a good closing agent, because they'll go through the closing documents with you and explain to you what each document that you're reading and signing is. A lot of the closing documents also are repetitive. You'll get those on the initial disclosure package when you get an offer accepted on a home and you start the mortgage process with your lender. So a lot of repetitiveness in those closing documents, but a good title agent is going to be able to explain every single document you're going through and signing. Okay, and that sums it up for the loan costs sections of your loan estimate. So those are the costs, those are the hard costs that you pay. And now we're going to move over to the other costs, or the sections that cover prepaid items. So now we're going to move into the other costs and the prepaid sections of your loan estimate. And the first section of this group is government fees, and that's section E. So government fees, it could be your state charges taxes, recording fees, different things like that. So that section is actual fees. It's a third-party fee. The lender has no control over it, but that's where you're going to pay the state tax fees. And this is not property taxes. This is taxes that your state would charge to purchase a home. And what's contained in section F is fully prepaid items. So the first one is your homeowners insurance. So when you purchase a home, homeowners insurance companies want you to pay a full 12-month premium upfront at the date of closing. You can either prepay that prior to getting to closing, or you can get the invoice through the insurance binder that your lender will work with your insurance agent to request, and that gets paid directly at closing. The title company will pay them directly after the closing is over. You'll need to prepare to pay a full 12-month, full annual premium for your homeowners insurance when you move in. And homeowners insurance protects you as a homeowner in cases of disaster, storm damage, things like that. So that's your homeowners insurance. Look at that as car insurance. Something goes wrong, you have car insurance, pay a deductible, it gets fixed. Same thing with homeowners insurance. And it's important to find a good homeowners insurance agent that you can work with, because you want to make sure that your asset, the largest purchase that you're probably going to make in your lifetime of your home, that asset is covered with appropriate coverages in case something happens. You get a hailstorm, you get a windstorm, you got to replace a roof, you got to replace some siding, flooding in the basement, things like that. So it's always good, make sure you have good homeowners insurance on your property to protect that investment. The other costs that are in this section, so you got 12 months of homeowners insurance, prepaid interest. So what prepaid interest is, with mortgages, when you make your monthly payment, you're paying for the previous month's interest. So when you close on a purchase of a home, let's say you close in April. If you close in April, depending on the day that you close in April, every day that's left in the month from the closing date to the end of the month, you pay interest on, because mortgage interest starts accruing the day you sign those closing documents. So prepaid interest at closing is going to be interest per day for every day that's left in the month. So the later in the month that you close, the smaller that charge is. If you close on the second, third, fourth of the month, there's going to be more days of prepaid interest. Prepaid interest isn't a bad thing. So one nice thing about mortgage financing, let's say you close on April 5th on the purchase of your home. So you pay prepaid interest from April 5th to the last day of the month. You pay that as part of the closing cost, prepaid interest. And then the next month, so May, you don't have a mortgage payment due yet because you're paying mortgage interest in arrears, meaning you're paying for last month's interest. So May, interest accrues every day for mortgage interest every single day of the month. And your first mortgage payment would be due June 1st. So you're going to have a full 30 days or 31 days, however many days are in the month, of interest that accrues plus your principal payment, and your mortgage payment comes due on the first of the following month. So every time you make that mortgage payment, you're paying the previous month's interest. So that's why you could close early in the month on a purchase and not have a mortgage payment for almost 2 months. Even though you're paying prepaid interest at closing for the days remaining in the month of closing, the next full month, interest is accruing for you to make your first mortgage payment. The last item in this section is going to be for property taxes. So every state is different with property taxes. Some states you make quarterly tax payments. Some states, like Minnesota is where I'm at, we make it twice a year, first half and second half. And some states you'll pay annually. So there'll be one payment due. For property taxes, I'm going to use Minnesota as an example. So in Minnesota, property taxes are due once in the spring for the first 6 months of the year and once in the fall for the second 6 months of the year. So when we're prepaying property taxes in this section, it's going to look at, has the seller already made the first half property tax payment, so the first 6 months? And if they haven't, let's say our closing date again is in April. So on that closing, the prepaid property taxes, you're only going to pay for the closing date and forward to get through the first 6 months. So if it's April 15th, let's say, you'll pay property taxes at a prorated amount starting April 15th through the end of June to pay your portion of the first half. The seller is going to be responsible for paying anything that accrued from January until the closing date of April 15th. That'll all be balanced. That's why it's good to work with a good title company. They're the ones who balance that out for you as well. Property taxes, if you're closing on April 15th, at the closing date, because property tax payments have already been made, most likely in April, beginning of April for the first 6 months of the year. So you're going to pay basically the seller back for April 15th through the end of June. So that's a prepaid amount. You're prepaying property taxes, and that's going there. Okay, so the next section is section G, and this is initial payment for your escrow account. I'll do a video on what escrow accounts are so you fully understand it, but it's basically an account where you make your monthly payment, principal, interest, property taxes, homeowners insurance. When you make your monthly payment, the homeowners insurance and the property taxes are pulled out and they're put into this escrow account. But when you close, there's got to be a prorated amount collected up front for homeowners insurance and property taxes. And the reason for this is what we talked about when making your closing date and making your first mortgage payment. So the lender and the title company will project out, if you close, let's say April 15th again, your first mortgage payment is due June 1st. So they know homeowners insurance, you're going to pay every single month with your mortgage payment until we come to April 15th. And then the lender is going to reach into that escrow account and they're going to pay your next full year premium of homeowners insurance on the anniversary date of your closing. So homeowners insurance companies get paid once a year, 12 months at a time. Even though you're making monthly payments, that for homeowners insurance, a portion of it is homeowners insurance with your mortgage payment. That portion is getting put in the escrow account and it's getting held until the lender reaches in there, or the servicer who you make your payments to reaches into that account and pays your homeowner's insurance directly for you. So they're going to prorate out on closing date on April 15th. You're not making a mortgage payment till June. Well, we know that homeowner's insurance payments are going to come due again on April 15th of the next year to pay the full 12 months. And they typically go out 2 to 4 weeks ahead of time. So we're going to project out what's going to be needed when that payment goes out of that account to make sure the full 12 months are in there for the next time it's due. So typically homeowners insurance, there will be a prorated amount of 2 to 3 months that are collected at closing to establish that escrow account. The same is for property taxes. Just like homeowners insurance, property taxes in this scenario, we talked about closing on April 15th. The first 6 months, so the first half property taxes are already made, which you prepaid some of that to pay the seller back. Now we're going to project out how many payments will you have put into that escrow account when your first mortgage payment is due June 1st. So you'll have June payment, July payment, August payment, typically maybe September payment in there, but typically early September, the payments will go out for the second half year taxes. The payments for the second half of the year taxes in Minnesota are due in October, but typically the servicer is going to pay them 30 days in advance. You may have 3 to 4 months of property taxes paid at that point through your regularly scheduled monthly payments that are sitting in your escrow account that will get paid out to the county. Well, what do we know then? Let's say there's 3 months in there, you're 3 months short. So typically your lender is going to collect and your closing company is going to balance to collect 3 prepaid months of property taxes that goes into your escrow account on the date of closing and establishes that account. So there'll be 3 months in there. You'll make 3 months of payments, and then that first payment, that second half property tax payment, goes out for 6 months with the 3 months you prepaid at closing plus the 3 months you made on your regular scheduled monthly payment. So that's the prepaid section. That may sound a little bit confusing, but don't overdo it. Don't overcomplicate it, because you're just prepaying for costs that you have for owning a home, homeowners insurance and property taxes. You're never going to lose that money. If there's a surplus in your escrow account, which they do analyses once a year, typically in April, and let you know if there's going to be a shortage or if there's going to be a excess in that account. And then your monthly payment, your regular monthly payment, will be adjusted based on either a shortage or a surplus in that account. And we'll talk about that when we cover what an escrow account is, so you have a full understanding of what that escrow account is that's tied to your mortgage. And then the last section of that loan estimate, the last section is section H, and this is other costs. So this is owner's title insurance, which I'll do a video on this, but owner's title insurance is an optional charge that you can elect to have or decline. But basically, it's insurance for you in case there is something that comes up on the title of the home, typically a lien on the title of the home prior to your ownership that wasn't discovered during the chain of title review that the title company does up front. It's rare that this happens, but me being in the business as long as I have, I will always purchase title insurance, because maybe a contractor did work on that house 6 months prior to closing. The sellers didn't pay him for the work, and there's a $5,000 bill that wasn't recorded at that time. But that contractor, after all their efforts to try to get paid for the work that they did, said, you know what, I'm going to file a lien against this home because I'm going to get paid for the work that I did on this property. If that lien shows up after you're the owner pays for it. Regardless if you're the one who had the work done or not, a lien can get assigned to your title of the home that you would be responsible for. If you opted to purchase title insurance pays for that. You don't pay anything. Title insurance takes care of it. So that's something I would say, always talk to your title company or your closing attorney about owner's title insurance to get their full rundown of it. They're the experts on this, but I just know anybody I work with, I suggest it's a small charge to have peace of mind that you're not going to get a big bill down the road that you had nothing to do with. And the other fees in this section can be surveys for the home, real estate commissions go in here. So real estate brokerage administration fees or real estate commissions that you're paying for your buyer's agent to help you find that property and do the negotiation with you. Whatever you agree to up front, if the seller's not paying for the real estate fees, they'll be listed in section H. And then in this loan estimate, then you got the two sections, the two main sections, the loan costs, and then the other charges or prepaid items are all tallied up, and that's your full total closing costs that you have. So it's called closing costs. It's a little misleading because about 50% of that is actual loan costs. So those first few sections we went through, and the rest of it is prepaid items for costs that you pay because you own the home. Property taxes, homeowners insurance, prepaid interest, things like that. So typically what you can expect, you have your down payment. So let's say you're doing conventional 5% down for a down payment. So you'll have your 5% down payment plus your closing costs. Closing costs typically run between 3 and 4.5% of the purchase price of the property. And then that's where we break out those closing costs, basically a 50-50 mix, could be a 60-40, 40-60 breakout of those fees, but it really comes down to how much is homeowners insurance and how much are property taxes in your area to determine if that percent for closing costs, that estimation of 3% holds true. Typically on higher purchase prices, when you get 400,000 and above, your total closing costs will be about 3% of the purchase price, and that's here in Minnesota. If you're lower than that, that's where we may see it be 3.5% or closer to 4% of the purchase price. Lower loan amounts, even though insurance and taxes may be a little bit higher, with those lower loan amounts, that increases that percentage a bit. I hope this helps. I hope this answers your questions. If you thought of anything while we're going through this video, or if you've had something on your mind, either reach out to me directly via phone, 612-590-8623, and we can talk through your questions that you have, and I'm happy to help you out, whether you use me or not, or whether you're looking to buy a home in the next 12 months or the next 5 years. Happy to help you out. If you thought of something that you would like covered in a video based on things you're seeing online, please let me know. I'll record a video and I'll notify you when I recorded it and it's posted, so you can reference the videos and go through my library. I'm going to have hundreds of videos on here eventually, but right now, just getting started. This is my 5th video, and we're going to keep going with other education, because the most powerful thing you can be as a buyer is an informed buyer to protect yourself and to make the best financial decision for you and your family. Until the next time, again, Mike Spindler, mortgage broker with Edge Home Finance. Give me a call if you have any questions, and I will see you on the next video.